G'day traders, welcome to wrap up for Wednesday the 20th of June. On the daily charts, it's today pretty much the same that we've been having for the last couple of days, and that's we've broken up above what was a strong resistance level. It should act as a support now. And these buyers have got a little bit of strength, a little bit of power, and they're certainly got having a little bit of a push here. So, but by all means, expect buyers and sellers to come in. There's no reason why the sellers can't at some stage have a go, but definitely want to place more weight to the buy side. At some stage too, do expect the market to come back and test around this 1330 area, kind of come down and have a look at it, maybe even bounce off it, and that should happen either at the end of this week or sometime next week. It shouldn't just take off without some sort of coming back and having a look at the level that it broke. As for today, FOMC announcement, so basically that's the major interest rates announcement in the US. It happens 8 times a year. It's a bizarre day. Let me take you through the day quickly, and I quite often find this is the case. What happens is the announcement normally comes out around lunchtime. So, and today is a pretty good example of what I normally see happens is you get quite flat markets leading up to the announcement. You can obviously see the announcement. This is when it came out here, but flat markets because people are reluctant to get in and do their normal trading because they know what's coming, and I guess they don't want to get caught out in the afternoon. So as a result, very minimal movement. Then all of a sudden, out comes the announcement. And contracts are very, very minimal. So as a result, you get this massive movement as the dome chews up the contracts to this level. It's really choppy. You can see each candle easily, a couple of points, and very dangerous and pretty much untradeable. So as far as any setups through here, I just put them down as void. And there's not a lot to really go through because when you get that sort of action, even the setups do come, they're unrealistic and they're certainly not based on real market action. So it'd only be taking a backward step by going through anything like that in my books. Have a look at the 5-minute chart here. You can see very sideways. We push down, come back here, and then it looks like the market's want to head down again, and it's just holding within this range here, and not really breaking up, not really breaking down. Certainly the downside looked more prominent. It's just got a tick lower here. When it's coming back here, it's holding those highs, so indications that it is wanting to head down. Just before the FOMC, it did get a push through here. All the other markets started pushing down, and then all of a sudden FOMC, and quite erratic markets. There was a 5-minute fade just in this area here, but again, it would have went 9 ticks. It would have worked, but just a risky area, one that you don't really want to be a part of. Best just to wait a day and take it from there. So that's FOMC, probably a really good example of it. The market really reacted. Sometimes it doesn't always react like that. There has been FOMC announcements where it has a bit of a move, and then within 15-30 minutes the market's back to normal, and it's quite a tradable afternoon. But I'd say most days I like what we had here. Anyway, so that's a wrap up for Wednesday, and I'll speak to you guys Thursday.